One AI data center can consume as much electricity as 100,000 homes. The largest facilities now being built could consume as much as 2 million. And they are arriving faster than new power plants, substations, and transmission lines can be completed. So when artificial intelligence and an entire city begin competing for the same electrical capacity, who receives priority and who gets left in the dark? This is the hidden infrastructure crisis behind the trillion-dollar AI boom. In a single year, global investment in data centers reached roughly $500 billion. But those facilities do not run on algorithms alone. They require enormous amounts of electricity, 24 hours a day, every day of the year. In the United States, data centers consumed about 4.4% of the nation's electricity in 2023. By 2028, that share could rise as high as 12%. That would make artificial intelligence one of the most powerful new forces reshaping the American energy system. The companies leading this boom are no longer competing only for chips, engineers, and better models. They are securing land near substations, signing long-term power agreements, financing new generation, supporting nuclear projects, expanding natural gas capacity, and purchasing access to electrical infrastructure that took decades to build. For utilities, energy developers, and infrastructure funds, this could become one of the largest investment opportunities of the modern era. But someone must finance the power plants, transmission lines, transformers, cooling systems, and grid upgrades to keep those servers running. The technology companies may pay part of that cost. Investors may finance another part. But if regulators allow billions of dollars in new infrastructure to enter the public rate base, ordinary electricity customers could be paying for assets built primarily to support private AI empires. And there is an even greater risk. What happens if utilities build decades of infrastructure for data centers whose expected profits never materialize? Who absorbs the debt? Who pays for the unused capacity? And who controls the electricity when demand exceeds supply? The race for artificial intelligence is becoming a race to control energy. And behind every glowing server hall is a financial chain connecting big tech, power companies, private capital, regulators, taxpayers, and households. To discover who truly benefits and who carries the consequences, we have to follow that chain from the data center to the power plant. For most of the digital age, the cloud was designed to feel weightless. A search appeared instantly, a file crossed the world, a video streamed without revealing the warehouses, cables, cooling systems, substations, and power plants behind it. Artificial intelligence has shattered that illusion. Training and operating advanced models requires dense clusters of specialized chips running all the clock. Those chips generate enormous heat. The heat requires industrial cooling. The cooling requires more electricity. What appears on a screen as a simple answer begins inside one of the most capital-intensive physical systems being built today. Nowhere is that transformation more visible than Northern Virginia. The region became the largest data center market in the world because it combined cheap and reliable electricity, dense fiber networks, available land, proximity to major customers, and generous tax incentives. Today, Virginia represents roughly 13% of reported operational data center capacity worldwide, and about a quarter of the capacity in the Americas. The economic benefits are real. Data centers support construction activity, property tax revenue, equipment purchases, and thousands of jobs across the wider economy. But the physical reality is more complicated. A typical 250,000 square foot facility may require around 1,500 workers at the height of construction. Once completed, it may operate with only about 50 permanent workers. That is the first contradiction of the AI infrastructure boom. The investment can be measured in billions. The electricity demand can resemble that of a city, but the permanent local workforce may fit inside a few office floors. And in Virginia, the electricity demand is growing much faster than the population. After remaining almost flat for years, the state's unconstrained power demand could double within a decade, with data centers as the primary driver. Even meeting half of the projected demand would be difficult. Under one scenario, Virginia would need to add the equivalent of a large 1,500-megawatt natural gas plant approximately every 2 years for 15 consecutive years. Other scenarios require enormous additions of solar power, wind generation, battery storage, transmission, and nuclear technologies that have not yet been proven commercially at the necessary scale. Virginia shows what happens after a data center market becomes successful. Texas shows what happens when nearly everyone tries to enter at once. By June 2026, the Texas grid operator was tracking more than 438 gigawatts of proposed large electrical loads. Nearly 89% of those requests were associated with data centers. That figure was not a realistic forecast of what would actually be built. Some requests may have been duplicated. Others lacked firm financing, secured land, or a completed development plan. But the size of the queue revealed something important. Companies were attempting to reserve far more electrical capacity than the system could possibly deliver on their preferred timelines. Texas regulators responded by creating a new process for large projects of at least 75 megawatts. Instead of studying every request as if it were certain to proceed, the grid would group qualified projects, test whether they were credible, determine how much capacity was truly available, and identify which transmission upgrades would be required. The problem was no longer simply generating more electricity. It was deciding which projects were real, which should move first, and who should finance the infrastructure needed to connect them. The federal regulators reached the same conclusion. In 2026, the Federal Energy Regulatory Commission ordered major regional grid operators to justify or redesign the rules used to connect enormous new customers. The reforms placed two questions at the center: whether data centers should bring part of their own power, and how much of the connection cost should be assigned directly to them. Virginia and Texas represent two stages of the same story. Virginia reveals the consequences of concentration after years of growth. Texas reveals the scramble for capacity before most of the projects even exist. Together, they expose the central constraint of the AI era. A data center can be planned, financed, and constructed within a few years. A major transmission line, power plant, or regional grid expansion can take far longer. The digital economy is trying to grow at software speed through an electrical system built at infrastructure speed. And when demand begins moving faster than the grid, access to electricity becomes more than an operating expense. It becomes an asset that companies can reserve, finance, control, and deny to their competitors. But securing a place in the queue doesn't explain who ultimately pays for the system. To answer that, we have to follow the money from big tech's balance sheets into leases, power contracts, utility investments, debt markets, tax incentives, and the monthly electricity bills of people who may never use an AI model. The financial chain begins with the hyperscalers: Amazon, Microsoft, Alphabet, Meta, and the cloud companies competing to build the largest computing platforms. They finance expansion through operating cash flow, debt, long-term leases, and commitments that can extend for decades. But the companies selling the AI service may not own the land, the building, the power equipment, or even the data center itself. One company may own the site. A specialized operator may build the facility. An infrastructure fund may provide equity. Banks or private credit funds may provide debt. The technology company may install the servers and sign a lease large enough to make the entire structure financeable. The project is held together by contracts. A long-term lease gives lenders confidence that the building will produce cash. A power agreement gives an energy producer confidence that electricity will have a buyer. A utility service contract gives the grid operator a forecast of demand. Tax incentives reduce the construction cost. Each agreement protects one participant by assigning risk to another. If this is the kind of financial analysis you want to see more often, subscribe to Capital and Consequence. Amazon's agreement with Talon Energy shows how far this structure can reach. Talon agreed to supply Amazon Web Services with as much as 1,920 megawatts from the Susquehanna nuclear plant in Pennsylvania through 2042. For Talon, the agreement creates a long-duration customer and a more predictable revenue stream. For Amazon, it helps secure enormous quantities of round-the-clock electricity for future data center growth. The transaction connects cloud computing directly to the economics of a nuclear power station. But it also exposes the regulatory conflict. When a data center draws power beside an existing plant, regulators must decide whether the arrangement removes electricity from the wider market, whether the customer is paying its fair share of transmission costs, and whether the grid remains reliable for everyone else. The contract does not eliminate the public system. It changes the negotiation over who uses it and who pays for it. The same tension appears inside regulated utilities. American Electric Power raised its 5-year capital plan to $78 billion as data center demand accelerated across its territory. The utility expects most of its projected new contracted load through 2030 to come from data centers. AEP also says signed large load contracts could provide as much as $16 billion in cost offsets for existing customers. That phrase, cost offsets, is central. If a data center guarantees payments, covers dedicated facilities, and remains responsible when a project is delayed or canceled, the customer creating the demand carries more of the risk. If those protections are weak, the utility may build first and recover later through rates charged across the system. This is where private technology investment can become public financial exposure. Utilities typically finance construction with a combination of shareholder capital and debt. Regulators then decide which investments are prudent, which may enter the rate base, and what return the utility may earn. That creates two competing arguments. Utilities say new infrastructure can strengthen the grid, support future development, and spread fixed costs across larger volumes of electricity. Consumer advocates argue that households should not subsidize facilities built primarily for some of the richest corporations in history. The difference depends on the contracts. Minimum demand charges can require a data center to pay even if it uses less electricity than expected. Exit fees can protect the utility if the project closes. Letters of credit and parent company guarantees can reduce the risk of default. Special tariffs can assign dedicated infrastructure directly to the large customer. Without those protections, risk moves down the chain. A canceled campus may leave an oversized substation. A failed developer may leave lenders with unfinished property. A utility may hold assets designed for demand that never arrived. A local government may discover that tax incentives produced fewer permanent jobs than expected. This is why the central financial question is not simply how much the AI boom will cost. It is whether the contracts keep responsibility attached to the companies creating the demand. Because profit is captured through ownership, leases, and energy sales, risk travels through financing agreements, regulatory decisions, and utility tariffs. And unless those rules are written carefully, the final payer may be someone who never invested in artificial intelligence at all. The most visible winners in the AI boom are the technology companies building the models. But some participants can secure their profits before anyone knows which model will dominate, or whether the final AI products will justify the money being spent. Hut 8 provides one example. In 2026, the data center developer signed a 15-year lease worth approximately $9.8 billion for the first phase of its Beacon Point campus in Texas. The initial agreement covers 352 megawatts of capacity. The customer was not publicly identified, but the contract was structured on a take-or-pay basis, with no right to cancel simply because its strategy changed. That structure matters more than the identity of the tenant. Hut 8 does not need to predict which AI application will become profitable. It needs to deliver a building, power connection, cooling system, and operating environment that the customer has already committed to pay for. The lease can support financing because the expected cash flow is protected by a long-term obligation from a highly rated counterparty. With renewal options, the total contract value could become much larger. The physical capacity becomes a financial asset. Land gains value because power has been secured. A building gains value because an AI tenant has signed a contract. A contract gains value because lenders believe the tenant can continue paying. This is how infrastructure owners convert the urgency of the AI race into predictable revenue. The customer still carries the risk that artificial intelligence may not produce the expected returns. The landlord can begin earning rent once the capacity is delivered. That distinction helps explain why data center stocks, infrastructure funds, and energized industrial property have attracted so much capital. The safest position may not be inventing the winning model. It may be owning the place where every model must run. Energy companies are building a similar position. In West Texas, Chevron and Microsoft agreed to develop one of the largest dedicated natural gas power projects connected to an American data center campus. The facility is intended to supply Microsoft for 20 years and could eventually reach approximately 2.67 gigawatts. For Microsoft, the agreement secures a path to electricity without waiting entirely for the public grid to expand. For Chevron, the AI boom creates a new long-term market for natural gas and power generation. For turbine manufacturers, construction contractors, equipment suppliers, and investors, the project creates another chain of revenue. One data center commitment supports an entire industrial ecosystem. But the deeper shift is happening in ownership. Digital infrastructure investors are beginning to acquire the companies that develop power plants, storage projects, and grid assets. ArcLight Partner Partners, a power infrastructure developer and investor, agreed to acquire ArcLight Capital Partners, a power infrastructure developer and investor, for approximately $1.1 billion. Google took even a more direct step when it acquired energy developer Intersect for approximately $4.75 billion. The strategy is clear. Waiting for utilities to provide a connection can take years. Owning or financing the energy development process can give a company more control over location, timing, costs, permits, and access to the grid. The industries that built the internet and the industries that built the electrical system are beginning to merge. That creates another class of winners, firms capable of controlling both sides. They can develop the data center and the energy project together. They can choose sites where land, generation, transmission, and computing capacity reinforce one another. Even the utility sector is consolidating around this opportunity. Large power companies are pursuing acquisitions and capital programs designed to expand their exposure to regions where data center demand is rising fastest. Scale allows them to finance more generation, purchase equipment in larger volumes, manage wider development pipelines, and negotiate directly with the largest technology firms. The first phase of the AI boom rewarded companies selling chips and cloud services. The next phase may reward the owners of turbines, substations, contracts, transmission rights, and energized land. These participants do not need to know which chatbot wins. They need computing demand to remain high and power to remain scarce. Because when electricity becomes the constraint, the institution controlling the connection gains leverage over every company waiting behind it. That is where profit begins turning into power, and it's also where the costs become easier to transfer to those with less influence on the contract.
The clearest test of who pays is unfolding in Virginia. The state's official review reached an important conclusion. Under the rates currently in place, data centers are paying the direct cost of the electricity service they receive. That matters because the argument is often simplified into a claim that households are already paying the operating bills of technology companies. The real problem is more complex. Data centers may cover their own immediate service while still creating the need for power plants, transmission lines, imported electricity, substations, and reserve capacity that would not otherwise be built. Those system-wide costs can affect everyone connected to the grid. Virginia's independent analysis estimated that a typical Dominion Energy residential customer could eventually face an additional $14 to $37 per month in generation and transmission costs by 2040. That is not a prediction of what every customer will certainly pay. It is a range produced under different assumptions about demand, construction, fuel prices, regulation, and how costs are allocated. But even the lower end represents a meaningful consequence. A household may never purchase an AI subscription, invest in a technology company, or benefit directly from a new data center campus. It can still be exposed to the electrical system built around that campus. The risk becomes greater when infrastructure lasts much longer than the commercial strategy that justified it. A data center project can be canceled. A cloud company can move capacity to another state. A new generation of chips can reduce the number of machines required. Demand forecasts can prove too optimistic. But a transmission line cannot be returned. A substation cannot be moved easily. The debt used to finance those assets still has to be serviced. Virginia's review warned that if projected demand fails to materialize, utilities could be left with infrastructure whose costs must be recovered from the customers who remain. That is the stranded asset risk at the center of the boom. Taxpayers face a second form of exposure. Virginia has used a sales and use tax exemption to attract large-scale data centers since 2010. In the 2023 fiscal year, the exemption provided approximately $928 million in tax savings to the industry. About 90% of the sector used it. Supporters argued that the incentive helped create the world's largest data center market, generating construction activity, property tax revenue, high-paying technical jobs, and billions of dollars in economic output. These benefits are real, but their distribution is uneven. Most of the employment impact occurs during construction. A typical facility may have roughly 1,500 workers on site at the busiest stage of the build, then operate with approximately 50 permanent workers once completed. The public therefore gives up tax revenue for an industry whose capital investment is enormous, but whose permanent local workforce can be comparatively small. Local governments may still benefit from property taxes. Construction firms may receive years of work. Landowners may see values rise. Nearby communities may receive the power lines, industrial land use, constant low-frequency noise, and pressure on local planning.
Other businesses face another cost: opportunity. A manufacturer, housing project, or smaller technology company may need the same substation capacity, transformer, transmission connection, and engineering labor being claimed by a hyperscale campus. When capacity is scarce, the customer able to guarantee billions of dollars and decades of demand holds the stronger position. The smaller project may not lose electricity it already has. It may lose the opportunity to connect at all. Even utilities can become vulnerable. A large customer can represent extraordinary growth, but it can also create concentration risk. Virginia's review warned that electric cooperatives could face serious financial damage if a major data center delayed, disputed, or failed to pay a sufficiently large power bill. Because cooperatives are owned by their customers, the remaining members could ultimately carry the loss. This is how the consequences spread. The hyperscaler makes the decision. The developer constructs the campus. The utility builds the system. The government grants the incentive. But if demand falls short, the cost can move outward to customers, taxpayers, lenders, local communities, and businesses that never participated in the original deal. Who gets left in the dark? It may be the household paying more for a larger grid, the taxpayer financing an incentive whose long-term return remains uncertain, the factory waiting for capacity, or the community discovering that a project measured in billions produced less permanent local value than the headline suggested.
Once electricity becomes scarce, access to it stops being an operating expense. It becomes power. The proposed merger between NextEra Energy and Dominion Energy shows how valuable that power has become. Announced in 2026 at $66.8 billion, the transaction would combine one of America's largest energy developers with the utility serving Northern Virginia's data center alley. The combined company would control approximately 110 gigawatts of generating capacity. It would also face a pipeline of proposed large electrical loads totaling roughly 130 gigawatts, driven mainly by data centers. Dominion alone reported nearly 51 gigawatts of contracted data center capacity and counted Alphabet, Amazon, Microsoft, Meta, Equinix, CoreWeave, and CyrusOne among its customers. The deal still requires regulatory and shareholder approval, but its strategic logic is already clear. Scale provides the ability to raise more capital, purchase scarce equipment, build generation across wider territories, and negotiate with technology companies that require electricity in quantities once associated with entire cities. A larger utility can offer more locations. It can move projects between regions. It can finance several power plants at once. It can survive construction delays that would overwhelm a smaller developer. In the energy economy behind artificial intelligence, scale does not simply reduce cost. It increases control over where capacity will be created and which customers will receive it first. Technology companies are reaching for similar control from the other side. Alphabet's planned purchase of energy developer Intersect would place data center development, generation, battery storage, land, and grid access within a more coordinated structure. That reduces dependence on utilities solving every problem first. A company that can develop computing and power together has greater influence over location, timing, technology, and cost. It does not own the entire electrical system. It no longer has to wait passively for that system to accommodate it. Regulation becomes the next source of power. When federal and state regulators decide how large data centers connect, they are also deciding which business models can survive. A rule requiring a customer to bring its own generation favors companies wealthy enough to finance a power plant. A rule allowing flexible consumption favors operators capable of moving workloads between facilities. A long exit fee protects the public, but raises the amount of capital required to enter the market. A long waiting period may be manageable for a hyperscaler with projects across several states. It can destroy a smaller competitor whose entire expansion depends on one connection. The same rules designed to protect the grid can therefore strengthen the companies already large enough to comply with them. This contest is becoming global. China has placed the integration of computing infrastructure and electrical networks inside its national strategy. Authorities want renewable energy to provide 80% of data center electricity by 2030, compared with approximately 11% in 2023. The challenge is enormous. Chinese data centers could add between 300 and 500 terawatt-hours of electricity demand between 2026 and 2030. Even the lower figure is roughly comparable to the annual electricity consumption of the United Kingdom. China's advantage is the ability to coordinate power generation, transmission, industrial policy, and computing infrastructure at national scale. Its weakness is that always active AI equipment does not easily adjust to variable renewable generation. Expensive processors generate no return when they remain idle, so operators want them running as continuously as possible. The United States relies more heavily on private contracts, utilities, investors, independent grid operators, and regulators. China can coordinate faster from the top. The United States can attract vast amounts of private capital. Both systems are trying to solve the same strategic problem: how to convert electricity into computing power before the other side does. Countries unable to provide reliable and affordable energy will face a different future. They may consume AI services developed elsewhere without owning the data centers, models, industrial capacity, or digital infrastructure behind them. Their companies may send sensitive workloads overseas. Their researchers may depend on foreign computing platforms. Their economies may become customers of the AI age rather than owners of it. This is why the energy empire extends beyond utility bills. Capital secures electricity. Electricity creates computing capacity. Computing capacity produces data, revenue, and technological influence. That influence attracts more capital and secures the next generation of energy assets. The cycle rewards those already able to finance it. And once power companies, technology platforms, and governments begin reorganizing around that cycle, the decisions become difficult to reverse. The final struggle will not be only over how much electricity can be produced. It will be over the rules determining who can claim it, who must wait, and whether the infrastructure created by the AI boom strengthens the wider economy or becomes a private advantage protected by public systems.
If you have stayed with us this far, subscribe to Capital and Consequence for more long-form documentaries about the money, infrastructure, and power behind the headlines. The evidence now points toward a future that is less dramatic than a nationwide blackout, but more consequential than a temporary construction delay. The most likely outcome is a tiered energy system. Texas is already building the model. When the state's grid operator found itself tracking more than 438 gigawatts of proposed large electrical loads, nearly 89% of them connected to data centers, it stopped treating every request as equally credible. Under the new Batch Zero process, projects of at least 75 megawatts are studied together. Developers must demonstrate that their plans are real enough to justify grid capacity and transmission investment. That changes the competition. The question is no longer simply who applied first. It becomes who controls land, financing, equipment, contracts, and enough credibility to prove that the project will actually be built. Federal regulators are moving in the same direction. Large customers able to bring generation, reduce demand during critical periods, or accept stronger financial obligations may receive a faster path to connection. The result could divide the market into three groups. At the top are hyperscalers capable of financing dedicated power plants, storage, transmission, and several campuses at once. They can move computing workloads between regions and wait through delays without abandoning the AI race. Below them are credible developers with strong tenants, long leases, and guarantees large enough to protect utilities and existing customers. At the bottom are speculative projects, smaller firms, and developers whose entire strategy depends on obtaining scarce grid capacity before the capital is fully secured. Those projects may remain in queues for years or disappear entirely. This is not electricity being rationed by a government decree. It is access being rationed through contracts, balance sheets, and the ability to absorb risk. But one variable could still overturn the structure: efficiency. The International Energy Agency's central forecast expects global data center electricity consumption to more than double by 2030. Yet its high-efficiency scenario produces demand 20% below the base case by 2035. Across the agency's scenarios, projected data center consumption in 2035 ranges from 700 to 1,700 terawatt-hours. If AI adoption accelerates and efficiency gains are consumed by even greater use, today's infrastructure plans may appear conservative. If models, chips, and software become efficient faster than expected, or if customers refuse to pay enough for AI services, some projects now presented as essential could become excess capacity. Utilities face the hardest version of that uncertainty. The IEA estimates that about 20% of planned data center projects could face delays unless grid constraints are resolved. New transmission can take 4 to 8 years. Wait times for transformers and cables have doubled. Gas turbines ordered today may not arrive for several years. Capital can reserve a project. It cannot manufacture time. The most powerful tool may therefore be flexibility. A data center that shifts non-urgent workloads, uses batteries, activates on-site generation, or moves computing between regions can reduce pressure during the most dangerous moments for the grid. But flexibility has a price. AI facilities contain expensive processors that generate no revenue while idle. The IEA estimates an AI-focused data center can be 10 times more capital-intensive than an aluminum smelter, making curtailment commercially painful. Companies will not provide flexibility simply because the grid needs it. Regulators will have to pay for it, require it, or make inflexible access more expensive. That is why the most probable future is neither complete privatization nor unrestricted access. It's a negotiated system. Dedicated generation for the largest projects, special tariffs and guarantees for major customers, flexible load requirements during emergencies, and slower connections where the grid is already constrained. Some regions will use the boom to finance stronger electrical systems. Others will build around forecasts that prove too optimistic. And the companies with the strongest balance sheets will secure the most options before anyone knows which forecast was correct. The final question is no longer whether the AI boom will reshape the grid. It already is. The question is whether the new rules will keep the cost attached to those capturing the profit, or allow the risk to flow outward until it reaches the people with the least power to refuse it. The trillion-dollar AI boom is building an energy empire, not through one company or one hidden agreement,
but through a visible network of leases, power contracts, utility investments, tax incentives, debt, and regulatory decisions. Virginia shows what happens when data center growth becomes concentrated enough to reshape an entire electrical system. Texas shows what happens when proposed demand becomes so large that the grid must begin deciding which projects are credible enough to receive capacity. The Amazon agreement connected cloud computing to nearly 2 gigawatts of nuclear power. Microsoft's planned project with Chevron connects data center expansion to dedicated natural gas generation. Alphabet's move into energy development shows that technology companies no longer want to wait passively for utilities to solve the problem. These are not isolated transactions. They are pieces of the same structure. So who profits? Technology companies profit when secured electricity allows them to install more chips, operate larger models, attract customers, and strengthen their position before competitors can obtain the same capacity. Data center owners profit from long leases and scarce energized land. Utilities can profit from approved investments in generation and transmission. Energy producers, equipment manufacturers, developers, infrastructure funds, and lenders profit from the physical expansion required to keep the servers running. Some of them can lock in returns through contracts before anyone knows whether the final AI products will earn enough money to justify the scale of the boom. And who pays? Technology companies creating the demand should pay through dedicated infrastructure, minimum charges, exit fees, financial guarantees, and long-term commitments. When those protections are strong, the financial risk remains closer to the firms expecting the profit. When they are weak, the cost begins moving outward. It can reach electricity customers through system expansion. It can reach taxpayers through incentives that the long-term return remains uncertain. It can reach utilities through stranded assets. It can reach communities through land use pressure and infrastructure built around decisions they did not control. It can reach other businesses through delayed or unavailable grid connections. The decisive issue is not whether data centers pay an electricity bill. They do. The issue is whether they remain responsible for the larger electrical system built because they arrived. And who gets left in the dark? The answer is not necessarily a city suddenly losing all power while a server campus remains illuminated. The more probable outcome is quieter. It is the household paying more for a grid designed around demand it did not create. The manufacturer waiting behind a hyperscaler for a connection. The taxpayer financing an incentive whose long-term return remains uncertain. The smaller technology company with a valuable idea but without the capital to secure land, generation, and transmission years in advance. The community that receives the power lines and industrial development while most of the permanent economic value flows elsewhere. Being left in the dark means having less influence over the decisions that determine where electricity goes, which projects move first, and who carries the consequences when the forecasts are wrong. But that outcome is not inevitable. The AI boom could finance new generation, modernize aging transmission, accelerate nuclear development, support storage, and create infrastructure that serves entire regions. The difference will be determined by the rules. If data centers pay for the capacity built specifically for them, the expansion can strengthen the wider system. If the largest customers receive priority while costs are distributed across everyone else, the energy empire will concentrate both computing power and economic advantage. Texas is already deciding which projects deserve access. Virginia is already calculating what expansion may cost.
Federal regulators are already rewriting the terms under which the largest customers connect. The system is not waiting for the AI revolution to finish. It is being redesigned while the outcome is still uncertain. That may be the greatest risk of all. The infrastructure being financed today could remain in place for 40 or 50 years. The AI companies, models, and forecasts that justified it may change within a fraction of that time. Software evolves quickly. Electrical systems do not. The companies that secure power first will gain more than lower operating costs. They will gain time, scale, market access, and the ability to survive delays that eliminate weaker competitors. Electricity will determine where AI can grow. Finance will determine who can secure that electricity. And regulation will determine who carries the cost. Subscribe to Capital and Consequence. Share this documentary with someone following the AI economy, and tell us, should technology companies pay the full cost of the energy infrastructure their data centers require? The AI boom may be digital, its foundations are physical, and the power claimed today will shape who controls the economy built on top of it.
For viewers who want the complete research dossier behind this documentary, the Capital and Consequence dossier is available in the description. See you in the next video.
Capital and Consequence. Follow the money. Understand the consequences.